Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Frank Rotman, founding partner with QED Investors, a venture capital firm focused on investing in early stage disruptive financial services companies. Frank, it's great to have you with us. Welcome to Trade Talks.
Welcome to be here.
And think about venture capital as an asset class, albeit a smaller one. Why the quick growth and acceleration now?
Yeah, it's really interesting. The public markets have been a great place for returns over 150 years, but a lot of the alpha, all of the yield that's been generated in the public markets has disappeared. I mean, there only are 10 to 15 logos that are out there that are really worth investing in, that have driven most of the return in the market for a long time. So a lot of the money that's been in the market has been looking for places to generate return, and one of the greatest places to look has been the private markets. So a lot of money has been flowing in, a lot of the returns have been great, a lot of exits have proven that the asset class is more liquid than people think and the returns are greater. So money just keeps flowing in.
And finding great early stage companies is highly competitive, meaning when a VC finds ones, they justify paying up to win based on increasing prices paid by late stage investors and extra returns generated by staying private longer. Has the art of possible been discovered in this process?
Absolutely. 14 years ago, when we first started and founded QED Investors, we were thinking that big outcomes of taking these early stage companies, building them into something that the public markets wanted, and then putting them in the public markets or selling them to strategics, we thought that outcomes would be in the hundreds of millions or low single-digit billions of dollars. And the art of the possible has been discovered now, especially in fintech, where some gigantic companies are being created both in the private markets, and then even more value is being created when they get put into the public markets. Look at Square, look at Stripe, look at Robinhood. You know, there are so many interesting companies that now the answer is tens of billions, if not hundreds of billions of dollars of value can be created by these companies.
Well, Frank, I guess the million-dollar question is, how do you exit at the right time? In other words, how do you determine when a company has scaled to be self-sufficient?
Well, hopefully it's not a million-dollar question. Hopefully it's a multi-billion-dollar question. But it's an interesting one. Historically, companies needed to be de-risked before they went into the public markets. But public market investors are really looking for return. They're looking for yield, which means they're willing to take on risk. So a lot of companies now are de-risking part of the business, but not all of the business. And the public markets are really accepting of business models that aren't 100% figured out yet. So there's appetite in the public markets for companies that are very high growth, very high top line, companies of the future, you know, where the opportunity to build something gigantic over long periods of time still exists. So in the past, you had to de-risk the entire business. You had to have the business model figured out. And now the public markets are looking for, you know, kind of half-finished stories because they want to generate the yield of figuring things out.
Yeah, and Frank, you mentioned at the top that the system's just so flush with liquidity now. And of course, 2021 was a record year bringing companies public. Do you see that same momentum in 2022? What trends are you going to be looking for?
Well, for the past couple of decades, the number of public logos has gone down, right? And only recently has the IPO market opened up to put a lot of new companies, you know, back into the market for investors to invest in. So this trend, I think, is going to continue. And as companies go public, it provides liquidity to a lot of the LPs that fueled the early stage ecosystem, and they want to put that money right back into the private markets. So you're going to see this cycle where companies go public, LPs put money back in the private markets get bigger, you produce big outcomes, LPs get more money, and this cycle is going to continue for a while.
Yeah, that's a good point. Frank, I appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.